All right, what's going on, team? Hope you guys are all having a wonderful start to your week here. Today in this video, I'm going to be talking about indicators, and this is going to be a pretty key component of my trading model. Now, it'd be nice if I could cover, every indicator out there and how to use them and this and that, but it's just not plausible. I mean, there are hundreds, if not thousands, of indicators, even just the ones on TradingView. I mean, I have, a couple dozen here as my favorites. If you go to the ones that they include on TradingView, I mean, there are just a boatload. And if you go to community scripts, I mean, there are endless, endless numbers of indicators, right? And how to use them and all kinds of stuff. Now, I would encourage you to try a number of different indicators if you're trying to formulate your own trading strategy, but in this video, I'm mainly going to be focusing on the ones that I use in my trading strategy that has been back tested for many years and I find work very well together. And those are going to be mainly composed of moving averages, as well as a slow stochastic and a CCI, which is a commodity channel index. Now, I'll go over each one of these individually, and I'm going to try and not make this video too long, but, I want to make sure we have a good understanding of what we're working with each one of these indicators. I also have volume bars down here. I'm just going to turn those off for now, as they're not really going to be... Ooh, excuse me. Goodness. They're not really going to be necessary for this, but there's a good chance that indicators will make more sense as we do some examples later on when we kind of bring everything together. But for now, let's focus on them piece by piece. And it's important to note that by themselves, none of these indicators are really crazy. I wouldn't want to take any one of these indicators and just make all of my trading decisions based off of that. If I had to use anything to base all my trading decisions around, it would just be candlestick price action, right? That is going to be the most powerful aspect of our trading and is going to be what we evaluate the most. But you start to add some moving averages, a stochastic indicator, and a CCI, and these two are momentum indicators, right? It's going to help with our timing. You can really improve your hit rate and just give you a slight better edge on trading. So let's start with moving averages. So if you're not familiar with moving averages, I mean, again, you can look it up on Google, of course, and that'll give you a whole rundown of it. But basically, it's just an average calculation of price over a given time frame. So for example, this green one here is the 200 period moving average. So at any particular dot, this is going to be the average price over the last 200 periods. So I'm on the daily time frame right now. So right here, if you look all the way over to the right, we can see our active price. So here the active is $25,403, meaning the average price from this candle and the last 200 all added together divided by 200 is 25,400. Okay? And in my trading model, I use two regular moving averages or simple moving averages. The 200, this is a very common one. You're going to find a lot of traders use a 200 period moving average. And then I use a 314 period moving average too. I find that often the 200 kind of gets either front run or pushed through a little bit, and often this 314 period is going to catch. And this is known as pi, the pi line, if you will. It's basically just pi, which is 3.14, multiplied times 100. And there's a lot of mathematics and kind of science that goes into why pi is such a useful moving average. Not going to go over all that in this video. But if you're really interested in that, I strongly recommend looking up Armstrong Economics. his economic confidence model. It's extremely interesting, and it kind of goes over why pi is so important and this idea of a global business cycle. But again, not going to be going over that in this video. We'll just focus on this is average price over the last 200 candles, in this case 200 days, and the average price over the last 314 days. And then these moving averages in here are exponential moving averages, or EMAs. Okay, and we use EMAs instead of regular MAs for our shorter period moving averages. Okay, because an exponential moving average is going to give more weight to recent price action, and we definitely want that when we're calculating average price over a smaller time frame. Okay, so for example, I have 3 of these that I really focus on. You can see the ones that are actually different colors: the blue one, the purple one, and the white one. You don't even really need the ones in between. These are all calculated based off of Fibonacci numbers, and so I'll pull these up here real quickly so you can see which ones we use. We use the 8, 13, 16, 21, 28, 30, 42, 50, 60, and you can see these are EMAs, and then the 2 simple moving averages, pi and the 200, okay? And so the most important ones for sure are the 8, the 30, and the 60. And I refer to these, and my mentor referred to these as the bands. They're EMA wave formation bands. So you'll often hear me refer to them as the bands. And more often than not, when I say the bands, I tend to mean the lower end of the bands near the 60 EMA, which again, 60 EMA is the average price over the last 60 periods. But as opposed to a regularly moving average, an EMA is going to give a little bit more weight to recent price action. So this candle may get more weight in calculating the EMA than, say, the 60th back candle, if that makes sense. So typically what we're looking for is these will act as support and resistance. You can see the 8 right here is quite often going to catch when we get dips on the lower time frame. So if we were to zoom in on this, right, say we're on the daily now, if we were to zoom in on the 4-hour, you would see a trend that looks something like this, right? Higher lows and higher highs, an uptrend. And then these lows, the higher lows here, are for the most part, and it will always be, but for the most part, they're happening at this daily 8-period EMA. Okay? And then when you lose that EMA, right here, and I have to apologize real quick, my cat is going crazy outside the door, and my yard guy is mowing the lawn outside, so if there's a little bit of background noise, I do apologize for that. Hopefully it doesn't, okay, he's going by. Hopefully it doesn't affect the video too much. Come on. Can we go to the backyard, please? My goodness. He hasn't been here in months, and of course I start recording a video today and he shows up. But, anyways, when you lose this 8-period EMA, which I'm basically just going to refer to from here on out as the 8. Okay, when you lose the 8, you tend to go to either the 30 or the bands. And again, the bands, I'm really just referring to the 60 EMA. Okay? And the reason for that is that on the lower time frame, when you lose this 8, right, that is a trend break. So you're basically taking this pattern of higher lows and higher highs, which we can see higher low, higher high, higher low, higher high over and over. When you lose the 8, you are making a lower low below this support. And I'm not going to zoom in on it here, but hopefully you guys get the idea. This is your little lower time frame uptrend, right? Finding support at the daily 8 EMA, and when you lose that, you have a new downtrend, right? And then upon reclaiming this 8 EMA, you have a new uptrend, a new little downtrend, a new uptrend here, and then from here on, once again, we start to hold this 8 EMA on pretty much every dip. And the big thing is how we close in relation to these EMAs, right? You can see here, if you were to zoom in, we go a little bit below the 8 EMA here. We go below a little bit here. We go below a little bit here and here. But the big thing is how we close in relation to it, right? We don't want to be super point specific. You know, if the 8 EMA is at $10,000 right here and price goes to $9,999, it's not a trend invalidation unless you close below it, okay? So that is going to be one of our most powerful tools. Typically, when you have an uptrend on, say, the 4-hour, you're going to want to look to this daily 8-period exponential moving average for opportunities to buy the dip. And then when you lose that, that's going to be a time when you want to be a little bit more cautious and see if you're getting a trend reversal on lower time frames, okay? Because once you break the 8, price tends to move towards the 30 or the 60, aka the bands, right? And that's pretty much what we have happen right here. We find support down at the bands, and then we reclaim the 8 EMA in here, and we once again have a new uptrend on our lower time frame, okay? And then we lose the 8 EMA here, and that's a new downtrend on the lower time frame. So this is going to be one of our most useful tools. Again, I'm not going to go extremely into it in this video. It's going to be more helpful and useful to kind of dive deeper as we get more into the strategy of how we're going to use this with regards to our trades. But that's the most important thing to understand, is that it is a support and resistance level. As you can see here, when price breaks below the 8, it tends to move to the bands. And when you break below the bands, they start to flip when your trend begins to flip. As we can see, if we hide the candles, it's a really good way to identify what the trend is. And there's 3 main trends that we're going to focus on. An uptrend, when all of your EMAs are rising and price is trending above them, right, or in them. And then you have a sideways market where there's a lot of uncertainty. Not a great place to be trading unless you're trying to be a range trader and you're just scalping on the lower time frames, which you definitely can do. So we have uptrend, sideways trend, which you can see by these bands getting really tight. You know, the 8 EMA is down, then it's up, then it's down, then it's up, then it's down. There's a lot of indecision here. It's going to be a lot harder to trade here than in a trending market. And then when the bands flip, where instead of the 8 being on top and the 60 on the bottom, the 8 is now on the bottom and the 60 is on the top, this is a downtrend. And you'll see if we turn our candles back on, they are trending below all the EMAs now, right? So in this period of time, you would want to be betting on lower prices versus higher prices, okay? And again, I know I've, been saying it over and over, but it'll make a lot more sense as we dive deeper into the strategy of how we can use this in taking trades. But let's not focus too much on that right now. Let's just hit on the most important part, that this is our support and resistance. Just by looking at the bands, you can tell this asset is an uptrend. Okay, this asset is in a downtrend. It's in an uptrend. It's in a sideways price action. It's in an uptrend. It's in a downtrend. Sideways price action. Downtrend. Sideways price action. Downtrend. Sideways. Downtrend. Uptrend. Sideways. Uptrend, right? That's going to be one of the most important things, is it can give us our trend direction at a quick glance. You could go through 100 charts very quickly, and just by looking at the direction of the bands, you can tell what the trend is, okay? And it's the same for our longer period moving averages, in the same way that when you break the 8 EMA, you tend to move down towards the 30 and the 60. When you break the 60, you tend to move down towards the 200 and pi, which we can see happens right over here. Okay, so we'll go into more detail on how we can use these later. I want to go ahead and quickly go over the other two indicators that I use. And the best trades are going to come when you have a confluence between all of your indicators and price action. So, for example, when we switch from making higher lows and higher highs on the daily to lower lows below here and a lower high, and then we break below the bands all roll over, and now the 8 EMAs below the 60, we have a downtrend in price, and we have a reversal in our EMA direction. Okay, so that's two signals. And then the next one will be, let's focus on this stochastic indicator. So this is a momentum indicator. Again, if you want to go online and look up, how is a stochastic calculated and all that, I'm not going to go over all the formulas and stuff. I don't feel like that is extremely useful in the actual trading aspect. But essentially, when this stochastic gets low, the asset is known to be oversold. Okay? And when it gets high, it's known to be overbought. Useful takeaway here, we want to be a better buyer at the low end and a better seller at the high end. And in an ideal world, you would have an uptrend like this or a downtrend. I focus more on uptrends because I tend to trade on the long side more, but it's the exact same thing in downtrends, just reversed. In an ideal situation, you would have a stochastic cycle high with the peak in price and a low with the bottom in price, right? That would be the most ideal, and it's not always going to happen that way because trading is not that simple. But this is the general idea, right? You really want to be a better buyer when your stochastic cycle is low and a better seller when the stochastic cycle is high, okay? And we can see that all throughout here, really. Cycle is low, you want to be a better buyer. Cycle gets high, you want to be a better seller. Cycle is low, you want to be a better buyer. Cycle is high, you want to be a better seller. Low, low, high, high. Low, low, high, high. Low, low, high, high, and so on and so forth. I mean, we can just keep going through it over and over and over. And that is how we really want to use it. Not to point out, oh, this is overbought or oversold. It gets low, I have to buy. It gets high, I have to sell. It's not like that. It's more of a timing indicator, right? It's recognizing the cycles that price tends to go in. And price does move in cycles, right? You will cycle high and then low and high and then low. And it won't always be this perfect. Sometimes you'll cycle high, you'll come down a little bit, and you'll stay high. Sometimes you'll cycle low, and you'll come down a little bit, and you'll stay low. Okay, so just because the cycle gets low does not mean immediately buy. And just because it gets high does not mean you immediately sell. It's not that simple. But the best buys are going to come in when we can get a confluence of multiple indicators. For example, here we find support at our 30 EMA. We close back above the 8 EMA, and we get a bullish cross on our stochastic indicator. And you can see one of these lines, this green one, is crossing over and under this red one. That is going to be known as a cycle cross, right? So this red line here is more static in that the red line will only change after a candle close. But this green one is dynamic. It's going to change during the candle as it's moving up and down. And that is going to give us, kind of our signals. Okay, so just because the red line is getting high does not mean it's necessarily a great time to sell. But once this green crosses under it, that is what we call a cycle cross, okay? So if you get a breakdown on trend at the same time as your cycle comes up and you get a cycle cross, now you have a confluence of indicator and price action. There's a good chance that's a good time to sell, okay? And again, it's the calculations of this are a little bit more complex, but that's the general idea, right? We want to be a better buyer when our cycle is low and a better seller when our cycle is high. Keep it simple. Don't overcomplicate it. It'll make a lot more sense when we get into examples. And then the last indicator that I use is another momentum indicator known as the CCI, or the Commodity Channel Index. Very similar to an RSI, or a Relative Strength Index. They're very similar. Whichever one you want to use, they're going to do the same thing. And it's quite similar to the stochastic in that it's a momentum indicator. So if you were to add this to your chart, it would probably look something like this. It's going to look like a line because this is just a moving average of momentum. But I prefer to use a histogram. And again, you can go into the little settings wheel here, go into your time interval, click this little button here, and change it to a histogram. And I find this represents the values a lot better than just a line, but they both do the same thing. Essentially, while this value is rising, momentum is increasing, right? And that is going to be good for longs, i.e., prices will be rising 9 times out of 10. And when momentum is falling, that is going to be good for downwards price action, and typically that will be accompanied by a move lower in price. So how can we use this in our trades? Again, we'll go into more details later, but we're looking for a confluence, right? So here's a good example. And again, the most important thing out of all of this is always the trend of price action, right? None of these indicators mean that much without something with a trend, right? So, for example, here we have higher lows, higher highs off of our 8-period EMA, higher lows, higher highs. And then here on the lower time frame, we're going to get a breakdown in higher lows and higher highs. Let's actually go ahead and zoom in for this example so you guys can get a better idea of what I'm talking about here. Right? So this is what we're just looking at on the daily. Now we're on the 4-hour. Okay? Price is making higher lows and higher highs, higher lows, higher highs, so on and so forth, higher lows and higher highs. And then here, boom, we have a breakdown of this trend into a new little downtrend here. Okay? So there's our price action flip, right? We've switched from uptrend to downtrend on the lower time frame, which happened right around here. At the same time, our stochastic indicator is very high, and the green dynamic line crosses below the red static line. So we have a cycle cross, we have a breakdown in our lower time frame trend, we lose the 8 EMA on the daily, and then we get a big 20% dip in price. Okay? At the same time, we have a rollover in momentum. Okay? During this uptrend, momentum had been steadily increasing, and here it rolled over. So now we have a rollover in momentum, a cycle cross, and a breakdown in our lower time frame trend. So if you had been involved in this trend the whole time, this would be a really good time to be taking profits and reevaluating your position in this trend. Okay? So That's pretty much it. And again, it's going to be hard to really fully explain how we use this in a little 25-minute video, but I just wanted to give you guys kind of a little intro to these. And again, there are hundreds of useful indicators out there, but one thing that's really important is to not just add 20 indicators to your chart. More is not always better. Sometimes I don't even look at these. Sometimes all I really care about are the EMAs. And sometimes I just want to look at price action because it's really going to be the most useful thing of all of this. Without price action, the indicators are not really going to do that much for us. So, level of importance, price action, and then our EMAs, and then our momentum indicators. Okay? Alone, none of these are that powerful except for price action. But together, we can get a really good edge on the market. Okay, so I'm going to give plenty of examples of how we can use these all together as we go through this course. But for now, I just kind of wanted to give you guys an intro to the indicators that I use. So we'll just go through it real quick once more before I wrap up. We have two longer period moving averages, the 200 MA and the 314 MA. And then we have the waveform bands, which is a set of EMAs ranging from 8 to 30 to 60, aka the 8 and the bands. That's what I usually refer to the low end range as, the bands. And then we have two momentum indicators that will help us with our timing. Okay, a slow stochastic. And if you guys want to know the actual settings for this, I use 5-3-3. 5 being the length, smooth K percentage 3, smooth D percentage 3. Again, I'm not going to go into the whole details of how this is calculated. Essentially, this is just determining how smooth the stochastic is going to be. If we start to adjust these values, you'll see it will change the smoothness of this. No one is the best necessarily. It kind of comes down to preference. I prefer a little bit of a more active one. So I use 5-5-3, but you can use a higher value if you prefer. I just find the lower value works a little bit better, but feel free to mess around with it, see what you like best. But that's what I use. And then this is a custom indicator, our CCI, which you can get from the Blockcircle Discord, but you don't have to. It's a public indicator, the commodity channel index. You can add it to your chart, and again, it'll look a little bit different than mine, but that's because I have changed mine to a histogram. I've gotten rid of some of the background noise and stuff that I don't like, and yeah, I definitely prefer how we've got it set up, but it's the same indicator. If you just want to use the public one, by all means. And then another thing I forgot to note about the CCI, and this will be the last note before we wrap up this video, is that there is a 0 line directly in the middle here. I have outlined with this dotted white line. You can see over here it is the 0 value, as in 0 momentum, right? So we want to be on the long side, and we want to be better buyers while we are trending above. That's a poor drawing. While we're trending above this 0 line. And then when we're trending below, you're going to want to be a better seller. And you can see during our strong uptrends, the CCI is trending above 0. During our stronger downtrends, the CCI is trending below 0. Okay, so again, we'll go into a lot more detail later on how we're going to make use of all this stuff. I know I've said that like 30 times at this point, but don't feel too overwhelmed. Don't feel like you have to use these either. Again, the most important thing is price action. These are just going to help us get a little bit better of an edge as best we can, so we can hit the best trades at the right time. Okay, so hopefully that made a lot of sense. Again, if it didn't, you're always welcome to reach out to me in the Blockcircle Discord. I'd love to help you however I can, but the rest of this course will go into a lot more detail on this, and more importantly, how we can execute trades based off this set of information. Okay? So, yeah, I will see you guys in the next video. We're going to hit on Fibonacci levels a little bit in that one. And then after that, we can talk some classical charting patterns, and then we'll really get into the meat of candlestick setups. And that's probably going to be one of my favorite videos because that is focusing on price action. So anyways, you guys have a great rest of your day. I will catch you all in the next video. Peace out.